Hello, everyone, and welcome back to another episode of BIF Bites. 2-for-1 special in March. We already had one earlier in the month, but we wanted to give you guys even more awesome content, so we're recording another one for the post-exam cycle. How you guys doing?
Taking a deep breath.
I was better with the last March BIF Bites.
Right. Yeah, pre crash BIF Bites.
Yeah.
So lots of people have a lot going on between coronavirus, the market crash, people finishing up the exam cycle.
Yeah, I mean, could there have been a worse possible week for somebody trying to focus?
Yeah, for someone in the financial industry, like, oh man.
Yeah, in some respects, I suppose some found the exam to be the nice break from all the stress that was going on between virus and the market meltdown. Maybe they enjoyed their time more, which should.
I talked to one student who sat for the exam, and she said that she came out of the exam and got the pass, and she was so excited, and then she looked at her phone and saw she had like 40 emails in the time that it took her to take the exam. Wow. So
Yeah, I'm assuming they weren't good emails.
No, definitely not good.
They
emails.
were congratulations or good luck, right? Yeah.
No, they were panic sell emails.
Yeah.
But that is what we wanted to talk about today. To kind of remind all our listeners that we've seen stuff like this before. We'll see it again. While history doesn't repeat itself, it certainly does rhyme. So we kind of wanted to take a look back at kind of the history of market crashes in the 20th century and, kind of see what lessons we can take from them and how we can apply it going forward. Sound good to you guys?
It does.
Yeah, I imagine many of those same feelings have repeated over and over.
Right. Do you want to just dive right in? We have a nice little list here of all the bear markets of the 20th century. So a total of 11 bear markets from 1900 to 2020. Up first, I guess, can't really start a segment like this without mentioning the big one, right? The one that everyone always talks about, the Great Depression. September of 1929, the stock market crashed and lasted for about 34 months was the length of the big crash, where S&P ended up dropping about 86%. Like, I guess, does that make you feel good, Brendan, knowing that at least we're not at those levels yet?
No, because it makes me know that level is possible. Right?
Oh.
So, and precedented, right? So that's, yeah. But, when we take a look at that was really coming out of the Gilded Age, and there was a lot of, excesses in the system all over the place. There was also, when you take a look at the timing of it, when we take a look at the Securities Act of 1933 and the Securities Act of 1934, it truly was the Wild West in the late 20s in the market. There was all sorts of manipulation and schemes and lies, and none of that happens anymore, I'm sure. But it was much easier to do it then. And so, we saw the much needed legislation and certainly the depression that followed for really over a decade was predicated on both the U.S. Congress and the central banks of the day really doing the absolute wrong things. And as a result of their mistakes, central bankers and the fiscal people, White House and Congress today, have a much better understanding of which dials they should turn when. That definitely it's to do exactly the opposite of what happened in the late 20s.
Right. So, I mean, back then, schemes such as like pump and dumps, high pressure sales, these weren't not only legal, they were common practice and, the bread and butter of a lot of the salespeople back then.
Yeah. And the SEC wasn't even in existence, right? So it was just a totally different type of market in terms of regulation, in terms of participants, and Americans didn't really trust it. I think that they participated regardless of that, but By and large, the market of that era looks nothing like the markets that we have today.
Well, yeah, especially just from a numbers point. So we bring up the percentage loss of 86%, but it's kind of hilarious when you compare it to the points loss. The S&P 500 went from a whopping 31 points to 4 points. That was the drop in the S&P. Whereas today, I'm pretty sure the S&P has dropped 31 points in the span of 5 minutes.
Yeah. Yep. That's what's interesting when you see about it today, and that's why always you should be looking at things in terms of percentages, because as the market grows and we take a look at the Dow and the S&P and where they were a month ago. Obviously, the points are much higher, so the point swings seem like they should be much more impactful. But when you take a look at it from a percentage standpoint, nothing will compare, hopefully, to what we saw in 1987, which I'm sure we'll get to in a little while.
Yeah, definitely. And I think the other takeaway from the Great Depression is also just the length that it took 34 months for the stock market to recover. And it's a lot of people are already trying to make predictions about the current bear market we're in, how long it's going to last. I don't think anyone knows unless they have a crystal ball, but I think that duration of the bear market is something we're going to want to pay attention to as we take a look at all these lessons from history.
Sure.
Yeah, it's always interesting that the quote unquote experts are always on TV explaining in excruciatingly minute detail why what they had predicted last week didn't happen. And I'm of that opinion, as nobody has a clue with this. Now, in the 80s, I had a lot of clients who had lived through the Great Depression, and the idea of having mattresses full of cash or grocery sacks full of cash, I encountered that frequently early in my career. I'll tell a quick story about this because I had a client and his wife had died, and we had done quite a bit of business together. And he called me and said, and his wife had died maybe 2 months, 3 months earlier. And he called me and said, "Hey, I want you to come over. There's some more money I think should be invested." And so we go, and he had found sacks and sacks full of $100 bills that his wife had stuck away, and he knew nothing of. And he said, we need to do something with this. So, and this is in a suburb of Chicago that had been known for plenty of gang activity.
I was going to say, was his wife's name Al Capone? Yeah.
Yeah. All the pillowcases had Al Capone stitched into the tag.
Yeah. So we go to the bank, right? And he's gonna put it in the bank. And I didn't really look at that much. I just didn't. I said, well, let's go. And so we go to the bank, and then they start looking at this, and there starts being all this commotion back where they have these bags, and then they call in some of the officer people. And they're looking at it, and they're looking at us. And I was like, "Oh my gosh, it's counterfeit! This guy, and I'm here with him. I had nothing to do with it." And then they came and said, "We think that you might want to rethink just a deposit with this." Almost all of them were silver certificates.
Yeah.
And so at that time, they were worth more than just the face value.
Yeah, that's right. Yep.
And
wow.
Because what year was this, Mike? This was back when the what was it, the Hunt brothers that were cornering the silver market?
This would have been early 80s.
Yeah.
Maybe 81, 82 along there.
Yeah.
And I thought I was going to jail for going to the bank with the guy, and I don't know what it ended up being worth, but it was significantly more. So people were really doing those things, stuffing away money, and I hope we don't see that again. But it sure reminded me of it.
I have a feeling if someone walked through my door with bags full of money, I think I'd probably be fired on the spot.
Yeah.
Cash is not seen as kosher in this business anymore.
No.
Yeah,
no,
exactly. Yeah.
No, it is not. It's actually funny. I remember the firm I used to work at. It was in this big old, like they've been there for 100 years. So they actually had a massive vault in the building that they now use to hold all their office supplies because they don't have any cash or gold or anything on hand anymore. So they just have this massive vault that they use as a, basically cleaning supply cabinet now.
Yep. There used to be teams. Banks used to have teams that would be called reclamation teams, and when they would shut down a vault, they would send in a reclamation team to sweep up any of the gold dust that might be in there because it was relatively valuable, and you'd be surprised how much they pull out of there.
Well, yeah, a long time for the total recovery, and what you guys were talking about earlier, that in between that time, there were some mini recessions in that same period.
Subsequent economic downturns that were. It was, I mean, because there was a really a perfect storm of events that occurred during that time where we had the Dust Bowl in the breadbasket. America at that point was still very much an agricultural economy, and that we just had a devastating drought, and it really forced a lot of people into bad situations, and so there was subsequent depressions that followed. Again, recessions, depressions. There's a very clear textbook definition of what a recession is, and it's not necessarily as clear for depression.
Yeah, so what we're using for this is as just kind of our benchmark is a 20% drop from peak prices is what we're kind of going off of as far, and that's kind of accepted. Obviously, there's people have different opinions on it, but that's more or less what scholars
would say the death of the bull.
Exactly. And so that is good to bring up, Mike, because that's something a lot of people don't realize about the Great Depression is the S&P 500 didn't return to its previous peak until 1954. So while the depression itself lasted 34 months, it took, decades for the market to regain its all-time highs.
In the midst of all that was obviously World War II and all of the impact that brought on the war and all the, from an economic standpoint, the death of that, that young men population is impactful to the economies of the world as well, and it throws things off. So it does take time certainly for the markets to come back.
Right, and that bleeds into our next bear market, which was in May of 1946, and it was no surprise, the year after World War II ended. That was basically caused by just all this, wartime production still being ramped up, but the consumption being way down. America was no longer at war. Transitioning back to a peacetime economy ended up having quite a few bumps in the road.
Especially after the little bump of, soldiers coming home and there were houses being built like crazy. They couldn't put them up fast enough. People buying cars for the first time in a few years. And then once that kind of wore off, I think was part of this drop.
And that's something we notice in the private sector a lot, that producers tend to ramp up production with the assumption that it's never going to end. They're always going to have the same demand that they have today. Mm-hmm. And when that demand tapers off, that's when you can see some crashes. And I feel that's kind of what we're in store in the future with coronavirus, where our first, the market right now is reacting to the supply issue where we can't produce goods. And now I think the second phase of it going forward is we're going to run into a demand issue where if everyone's staying home, no one's going out, consumption's going to end up being way down, and we're going to have a second wind of this market downturn.
Well, I sure saw something Saturday that I never thought I'd see in my lifetime. And I was in the grocery, and there were just empty shelves.
Yep.
On just about every aisle, there was at least one side of it or a good part of it that was just empty. And it was surreal.
Yeah. So right now we're in the supply side issues, but a month from now, when the production is caught back up and those shelves are restocked, you're still going to have people who just bought 6 years worth of toilet paper and now aren't going to buy toilet paper for a long time. Same goes with lots of other products that people are kind of stocking up on.
Yeah, well, that was one of the aisles that was empty for sure.
Yep.
Definitely.
Yep. Paper goods, Purell, Clorox wipes, things like that.
And alcohol and
Yes.
beer and whiskey.
Yes.
Yep. Good for cleaning and for spirits.
Yes. Yeah.
But yeah, before we move on, then just the 1946 bear market was a total loss of 29%, and then that one lasted 37 months. And I feel that's something we're going to see a pattern on. As we get into the more modern age, it feels like a lot of bear markets hover around that 30% drop amount.
Yeah, the 30%, that's correct. Yep.
And I believe we've already dropped 30% from all-time highs.
On the Dow, I don't know as though the S&P's quite gotten there yet.
Okay, yeah. So we've dropped
but the
30%
Dow
on the
has.
Up, but we haven't dropped 30% on the S&P yet.
I believe that's correct.
Yeah, that
Yeah.
sounds right.
Let's see what happens after hours, but
Right.
yeah.
Up next, December 1961, which is this like a forgotten bear market? I don't think I ever read about this in my history textbooks or anything like that, but it was in response to the Bay of Pigs attack. I never knew the Bay of Pigs caused
Well,
a
also
bear market.
the Cuban Missile Crisis.
Yeah,
So
yeah.
it was literally the point where everyone was hunkered down, thinking that we were about to get into a nuclear war, and so so it certainly was a pretty significant downturn. But
I
not
think
along
that
the
was
way.
when the Berlin Wall was either finished or started as well. In that same
would
time
make
frame.
sense. Yeah, the beginning of the Cold War for sure.
Yeah, so just
The real beginning of the Cold War.
Yeah, back to back, Bay of Pigs, Cuban Missile Crisis, Berlin Wall, caused a bear market. Which, maybe it's just all these events overshadow the financial history of it. But I never really it never really clicked in my mind. I've never had someone point it out to me that there was a 28% drop in the market during that time.
Yeah, and I think it's interesting when we take a look at that. We take a look at there's going to be also another common theme that runs through a lot of these significant drops in the market, and that is it's not necessarily bad news, but it's the uncertainty surrounding bad news. And so back in this period, we certainly didn't know what was going to happen, and we start to price in the worst case scenario, and so you see these drops, and then when it diffuses, the situation completely diffused, the markets shoot right back up, which is why this was such a short lasting event. But markets, people can make money in good news environments, people can make money in bad news environments, but when there's uncertainty, markets tend to pause and go to cash or go to safety, because they don't know which way to go, and so uncertainty can be the most dangerous markets.
And it is interesting that it was so short. It was only a 6-month bear market compared to years of previous bear markets.
And there were some pretty significant drops that happened, again, for shorter periods of time as, the Vietnam War was really starting to rage with our involvement at that time. So there were some, if you just look year by year, there were some blips in there too.
Yep.
Yeah, definitely. These are the big drops, but yeah, there are certainly lots of little divots along the road, that we're kind of glossing over as we go. So far, first one we tackled was caused by just rampant speculation, lack of regulation. Second one was just overproduction, trying to transfer from a wartime to a peacetime economy. And now the third one is kind of the first just, I would feel news-related recession, just based off of, people wondering what's going to happen next. It's not really based on any not necessarily economic factors, but it's more a psychological-driven bear market than the previous two were.
Yeah, it's a black swan event. It's something that you're not expecting, right? It's not anything that anyone predicted. It's way out in the margins in terms of probability, and it just shows up. Once it shows up, you got to contend with it, and it tends to lead to very high uncertainty, and as a result, that pretty negative market outcomes, and pretty severe. Pretty quick.
Yeah, definitely. And it kind of led into the next bear market, which wasn't too far after. Just 6 years later, November of 1968, there was another bear market that coincided with Richard Nixon getting elected. Though I don't know if he was the cause of it necessarily. But inflation was pretty high at this time. They were having 6% inflation, which is kind of crazy to think about in today's context. When was the last time we had inflation that high, do you guys think?
Well, there's definitely pretty significant inflation in the 80s. Since the 90s, the one of the bigger issues that we face as an economy is the lack of inflation.
Right.
One of the things that we're definitely dealing with today. But back, it was relatively common. I mean, in Mike, so back in 1982, 83, what were the mortgage rates looking like?
Well, I mean, you could get 15% on a money market account back
but you're
then.
paying
So
18% on a mortgage.
yes, that's the other side of it.
Right.
It's credit card rates.
People
Yeah,
were just
23%
nuts about,
looks good.
Money market accounts paying me 15%.
Yeah.
But yeah, inflation was high.
Yeah. So those inflationary events are risky to economies. Deflationary or stagflation events are dangerous to an economy, as we can see with really what's occurred in Japan for a long time. And arguably what's been happening here for at least the last 12 years.
Well,
Yeah.
in that period as well, with Vietnam again, we started having big protests,
Right.
Yes.
destructive protests, and event like Kent State where students were shot by National Guard.
We had two political assassinations in that time with Martin Luther King and Robert Kennedy.
Yep.
So it's just
And
today seemed pretty tame.
the Tet Offensive was in that period as well.
Yep.
So it was in turmoil for sure.
People were just nervous all around.
And again, uncertain. Where is all of this leading us as a society?
Yeah, and it definitely shows because the next bear market, right on its heels, 1973, next bear market was in result of the Yom Kippur War and the oil embargo, the 1970s oil crisis.
Yep.
So,
Which again led to consumption shocks because there was no supply.
yep.
Which led to people not being able to get what they want when they wanted it, and that they rationed fuel, and people would line up at the gas stations and not be sure that they were going to be able to get enough for what they needed, and it was definitely a not a great time.
Yeah, and that's actually something that we can see mirroring today. Like we already mentioned that supply issues is what we're suffering from right now. People are going to the store and they're walking out empty-handed because the thing that they want to buy isn't in stock.
Because someone that walked in before them bought like 100 of them. So
Right. True.
Yeah.
It's less shortage and more just hoarding mentality. So that is
Selfishness.
true.
Yeah.
Yeah.
Well, I remember thinking at that time that the world was going to end because gas had finally gone over $1.
Yeah. Yep. But back, so if you were to take a look at it, what was the average income for somebody in 1974? $1,500, $2,000 a year.
Yeah, and I think that's what brand new car would cost, something in that range.
Yeah. So,
College was $1,500, maybe.
Jeez, yeah.
It's okay. I'll just put it in a money market and I'll pay it off in a couple years.
There you go. Yeah.
Yeah, well, yeah, wait till the 80s. This money's going to be worth a lot in 1984.
Oh man. So yeah, 1973 market dropped 48%, which is actually the largest drop since the Great Depression. So that was a pretty significant shock to the market.
Yeah, and you also with the all of that. So we have these linchpins, right? But the black swan event then was the Watergate scandal and
Right.
the resignation of a sitting president, and it seemed like a complete unraveling of the entire political system. And that uncertainty led to just a shock in the market. People don't want to hold if they don't know what's going to happen.
Right. So, and Just to kind of give people perspective on the numbers, the S&P 500 went from 120 down to 62.
Wow.
So
Yeah.
still pretty manageable numbers, I'd say. We've seen that drop in a day easily.
Yeah. I think the S&P today dropped twice that amount.
Yeah, it dropped twice that amount today.
At the open, yeah.
Yeah. Yep.
But even under like I would like that would be a bad day in a normal market, but it wouldn't be anything to write home about, I feel.
Now, again, given where levels are now, it'd be just about a 4.5% move.
Right. So, and back in 1973, it was a 48% move of the needle.
Well, I mean, 119, the entire level of the S&P would be about a 4% move.
Right.
The 50 points would 50 points would be nothing. It would be a welcome change at this point.
True.
So,
And then rounding out the 70s, going into the 80s, getting into some more modern day ones that we can actually start drawing personal experiences from. The next bear market was in November of 1980, and the Federal Reserve raised interest rates to 20%.
yeah, and that's what Mike and I were just talking about, where your money market was great because you were getting huge percentages for taking zero risk, but the flip side is mortgage rates were just unbelievably high.
Yep. So Federal Reserve raising interest rates so high sent a shock to the economy, and the market ended up dropping 27%. So right around that 30%, actually closer to 28%, 27.8% drop in the S&P 500.
Yeah. And really, it's interestingly, the pushing rates significantly higher was one of the key mistakes that was made back in the late 20s to put us into that Great Depression. The response of watching the stock market crash was to raise rates, and that was the catalyst to really. And then they also raised taxes at the same time. It was the catalyst to really push the economy completely underwater.
Right. You see these strategies that we have in place to try and mitigate recessions ending up causing a recession.
Yeah.
Yeah, and it was I was graduating college at that time, and it was tough to find a job coming right out of school.
Yeah, I feel that's very reminiscent of the 2008 financial crisis too.
Yeah, much to my parents' chagrin that I was once again in their basement.
Yeah. Playing the Dungeons and Dragons in the basement, Mike.
But you've made a commitment to get out of there this year, right?
Yeah.
Well, partially. Partially. I'm working on something.
Yeah.
Oh boy. Up next, so I would actually call this the first modern day bear market. Black Monday, August 1987. And this is interesting because this is the first bear market caused by computers. Computerized program trading ended up causing, tripping circuit breakers and basically just causing a panic on the market when things just started falling and everyone started panic selling.
Yeah, I mean, there had been a series of subsequent downs in the market for the months leading into it. And then on October 19th of 1987, the market just completely fell out, and so it lost over 20% in a single day. And it's one of the reasons why we see the circuit breakers on the market, which have changed a lot since 1987. There's been a number of different iterations of the market circuit breakers in an attempt to allow cooler heads to prevail, allow the market to just take a pause and make sure that we're actually meaning to trade at these levels and it's not just something that's feeding into itself.
Right. This is basically the first bear market in which the speed of information is playing into it. People are able to get information faster than they can think about it and are ending up making rash decisions because of it.
Yeah, I mean, it was definitely I will never forget that day. I remember it very vividly as one of those areas where you are nervous. Like it seems like from a financial standpoint that we're going to go right back into that Great Depression type environment. But the market recovered, really quickly afterwards because again, it was a
shortest bear market, shortest bear market we've ever had at only 3 months long. Like,
yep.
Pretty. It was like a cold shower, basically.
Well, it's just again, cooler heads prevailed, and they realized that perhaps it was overcooked on the downside, and it allowed people to say, as we talked about in the behavioral podcast, that there's two dominant emotions that will deal with markets, and it's greed and fear. And so obviously, leading into that flush on October 19th. It was fear, and then greed came in, and people started looking at the value to which things had fallen, and started saying, is this really appropriately valued? And profiteering took over, and people started dumpster diving, looking for things that had really just kind of been thrown out, and established pretty significant positions.
Yeah, I got cooked good on that day. I was in the insurance business at those early years of my career, and it's when blood testing started happening for life insurance underwriting because of AIDS.
Yep.
And before that, you could write maybe as much as 1 million or more with just answering some health questions, and it went very quickly down to maybe 100,000. Is all one could get without blood testing. And there was one place that was doing, at that point, almost all of the testing, and it was going public. So I got in pretty big on that on Friday, the Friday before that Monday. Black
so
Monday.
You were the mush.
It didn't go to zero, but it killed me. And it never did get all the way back over a number of years. And then, competitors came in and all of that. So I remember that day, Brendan.
Your timing is good.
Yeah.
It's like that, other than that, Mrs. Lincoln, how was the play?
Yeah, really.
Did you, so let's talk about that for a minute. So we talked during the behavioral side about the snake bite effect or break-evenitis effect. Which of the two did you suffer from?
Well, I didn't really feel like, oh, how stupid was I? It was just who could have seen it? And then I was committed to stay in it for a while. But then I think I maybe held it another 3 years.
Okay.
And ended up still having a loss on it, even three years later. So.
Well, that certainly happens.
Yeah, definitely. But it did start one of the longest bull runs because our next bear market wasn't until 2000.
And just for the sake, we had a total different. The real evolution of what we know as Wall Street today really took place in that mid-'80s period, where going to Wall Street is what people were doing from Harvard Law and Yale Law and all the business schools, that people wanted to go to Wall Street, and so that's when money really started pouring in.
Right, that was the when the Gordon geckos started showing up.
Yep.
Well, that's a good point to be made as over all these years, if you would even think about what percentage of Americans held stock, that has just gotten bigger and bigger and bigger and bigger for a lot of reasons.
It's still relatively low. I mean, when you hear politicians talk about the impact of the stock market, and how it doesn't really, not necessarily reflective of what's happening in real America, and that the point is from them is there's only a 30-35% of the population that actually directly participates in any kind of these security markets.
Well, and even if you just take away 401ks, where it's almost like these people are obligated to participate, but they don't actually participate. If you take away 401ks, that percentage is even smaller, like less than 5%, I would say.
Well, the coronavirus is working very heavily at trying to take away 401ks as we speak. So
Yes, that too. But yeah, so after Black Monday ended up being one of the longest bull runs, 13 years.
Yep.
It did come to an end, though, with the dot-com bubble. March of 2000, the S&P 500 was at an all-time high of 1527, and it crashed 49% down to 776.
Yeah. And, certainly, again, not nearly to the same extent, but just a period of excess leading into it where, slap .com on anything and put it on paper and it goes public and it's going to triple or quadruple in the first couple of months of trading. So there was definitely there was definitely a lack of people really understanding what they were investing in. There was all kinds of new entrants into the market because of relatively low cost trading like Charles Schwab and the E-Trades of the world. So there was more access. But we also had September 11th of 2001 that kind of extended this a little bit and complicated it. Would we have stayed in it as long as we had without that, the terrorist attacks, who knows? But it certainly extended and certainly complicated things at that time.
Yeah, definitely. I mean, I think it was kind of just a 1-2 punch. I think if it wasn't for September 11th, this would have just been another kind of divot bump in the road. And then
it might have been 04, right? It was definitely coming. There was definitely going to be. We were on a road to perdition. Let's say that. I think that the terrorist attacks certainly expedited the outcome. And perhaps made it. I think you could argue that perhaps the patriotism and the unity that emerged, made the economy a bit stronger as people kind of bound together. So maybe it shortened it, but it certainly complicated it.
Right, and it is also interesting that we kind of see this as the start of almost kind of like a new business cycle with technology firms where new technology gets introduced. In this case, it's the internet. You see rapid adoption of this new technology. People pour money into it, and then people slowly realize that it's a bit overhyped, and you kind of get this big pullback in response when people realize, it's not quite there yet, because the internet of the early 2000s is not the internet that we have today.
No.
I remember being with friends, and we would just type in companies into the web bar to see. It's like, oh, let's see, Coca-Cola. Okay, Coca-Cola has a website. Let's see, Nike. Okay, Nike has a website.
This whole page loaded in just 4 minutes.
Yeah.
Right? Yeah.
So everyone is like, yeah, the internet's amazing. It's awesome. Right. It can do all these things, but the technology just wasn't there yet. And we had the exuberance for it, but it was not what it is today. It was not capable of doing the things that people wanted it to do, and it ended up having pretty drastic effects on the market. Are we ready for the biggest one since the Great Depression?
So far.
Yeah, so far.
Oh man, don't say that.
Let's not tempt fate
here,
the
market
please.
Closed?
Yeah, it is closed, yes.
Market's closed
thankfully.
right now.
You'll be happy to know it closed right on the low. So
October 2007 to March of 2009, the housing bubble and the subsequent financial crisis. Brendan, can you give us, and Mike too, can you guys give us a refresher, even though I'm sure this has been talked to death, but what in a nutshell was the financial crisis?
Well, I mean, from my perspective, there was a political shift in the country to make owning a home go from being the American dream to an American right, and so there was a vast, again, coming out of the terrorist attacks of 2001. The country kind of needed a win, and so there was this political appetite to really make it relatively easier for people to own homes. There was a lot more flexibility in the rules. Because the banks were basically able to sell the risk on to the government, there was a lot more appetite to really expand who can buy a house and what type of house they can buy. You come to find out that when you turn the rocks over a little bit, that there's a bunch of bad actors that were doing things that they certainly shouldn't have been, and it put a significant amount of risk into the system that people just weren't at all aware of.
Yeah, the way they were bundling them. I mean, I think at that time it was harder to get a library card than a mortgage.
Yeah, because you actually had to show some proof of identification with the library card. With the mortgage, not so much, right?
Yeah, but then when these started being bundled and offered as AAA, when maybe that first level but was in with a lot of really losers.
If that first level, and I think there was a big, there was people were putting these things together because they thought, well, what are the chances all these things go wrong at the exact same time? And so, it just allowed for these things that when just a little bit of a crack in the foundation occurred, the whole thing came tumbling down. And, ultimately it was credit default swaps that really led into, it was really almost the firing pin that blew the whole thing up. But then, the tide went out and we started exposing things like the Stanford Ponzi scheme and the Madoff's Ponzi scheme, and these other bad actors that were just doing these terrible things. And then, of course, again, the banks, who were arguably not necessarily operating in the best of faith either. And so there was questions as to whether or not the system itself was sustainable. And so we had this cascading failure, and the fear that banks were going to be nationalized, and there was going to be bail-in, so people's savings and checking accounts weren't necessarily going to be safe, and all of this stuff started to percolate into the market.
Same with response. Auto industry too. I remember there was a bunch of bailouts in the auto industry. People thought the auto industry was going to be privatized or nationalized.
Mm-hmm.
Yeah, I mean, it was just it literally was as there was no bunker to hide in, and during this time, there were a lot of people that began to question whether or not modern portfolio theory works, and they started to come up with post-modern portfolio theory, and really questioning whether if you have the possibility where all asset classes lose money significantly, then how can asset allocation possibly work? And certainly those things have kind of gone away. But in general, it was a very trying time. And again, you can't underestimate the impact that the fear that the system itself, the financial system, was going to fail in the country. You need as a society, especially a capitalist society, you need faith in the banks. You need faith that when you give your money to somebody, when you come to pull it out, it's going to be there. And there was a lack of trust. There was a lack of trust between people in the banks. There was a lack of trust between banks themselves. All this counterparty risk was out there that people were really afraid to kind of deal with each other, and the government did not do a good job of stepping in quickly enough.
Right. I mean, that to me is what the financial crisis really boils down to, was the breakdown of trust, because the real catalyst for it was the breakdown of the credit market. That is what this all circled around, and credit is trust. Without it, the wheels of the market stop turning.
Yeah, and that's really so the illiquidity, where people that need cash are not able to get it from people who have cash, and get trust is the big issue there. But the lack of liquidity in those markets really ground things to a halt. I mean, the system got pretty dark pretty quick.
I mean, it did, like we said, it did lead to pretty substantial government reaction, which we're seeing today now. Like the Fed injected, $1.5 trillion into the market?
Yeah. They to his credit, Ben Bernanke and Hank Paulson, who was the Secretary of the Treasury at the time, and Bernanke was really, he had taken over from Greenspan, Alan Greenspan, and he was really the perfect man for the job, because he had spent his entire academic and professorial career studying what got us into the Great Depression. And so he knew exactly which buttons not to push, right? And so He and Hank Paulson worked very closely, also with Tim Geithner, who was the president of the New York Fed at the time, and did the best they could. Right? I think people can look back and say, well, look at these terrible mistakes they made, and this was a stupid decision. But in the midst of it, the fact that those two guys survived without having heart attacks is unbelievable. And then they've left us, and they really threw all the hooks we had into the water. And now we're left still to this day trying to unwind that and struggling to do so. But at the time, it's what they thought. And the backdrop of this, so those are the monetary policy tools that they tried to implement, but they were begging for the Congress to get together on a fiscal policy stimulus, which led us to the Toxic Asset Relief Program, the TARP. And if you'll remember, it was back, I want to say it was October of '08. That went to the floor. It was voted on and rejected. The market just puked. It just couldn't handle it. And then they passed it and sent it to the White House, and the White House vetoed it, refused to sign it, and it got sent back. And so it took a few tries for that to go out. And it was very public, and it was very ugly from a market perspective, And then finally they got it resolved, and in the grand scheme of things, it was really, from a market perspective, it was really like June-ish of '08. And then the bottom was reached in March of '09. So it was a relatively short-lived event, but God, it was terrible going through it. And then it's obviously it's made records since then.
Right. And I mean, that's kind of the issue we're running into now, like you said, about as far as untangling all the monetary policy, is we've been at such low rates for so long, we didn't really have much room to turn it lower. We're at 0% Fed rate right now.
Yeah, we're back there. Yep, back there again. And so, back to 0% on central rates. We've deployed several other, repurchase agreement bailout. We've got potentially commercial paper bailout. So really, the Fed is focusing very much on liquidity of markets and doing its best to make sure that this biological issue that we're dealing with doesn't turn into another financial crisis where markets freeze and banks are at risk. And I think that's one of the big differences that we have right now is as a result of, the bad things that happened in '08, leading into '08. Banks now are forced to have much healthier balance sheets. And so the banks are very well capitalized. They're extraordinarily healthy. And so the risk to the system is much lower as a result of the Dodd-Frank Act. I think is somewhat cumbersome, but it's proved to be very beneficial for what we're going through right now.
Right. It's Dodd-Frank's always been one of those things that everyone gripes about until it's needed, and when it's needed, people are really thankful that we have it.
Yeah, it's a very robust piece of legislation.
So now, do you guys think that we're going to drift into negative rates?
Yeah, I mean, I'm leaning no. But I wouldn't have a lot of rationale to put behind that. But I'm leaning no at this time.
I mean, I would hope not. I think that I don't think we'll have negative rates as necessarily a policy decision. So if we take a look at the shorter end of the yield curve, might the market take that negative like it's done with others? It's certainly possible. I think it's unlikely. We were ironically greater risk a couple of weeks ago when the 10-year Treasury fell below 0.4,
right,
which is it was a shocking move in the 10-year Treasury, and now we're up around 75, 80 basis points. So it would seem it's certainly possible, but very, very unlikely.
Right. So looking at the current situation that we're in now, and having gone through all of these bear markets over the last 100 years, what are the lessons that we can take away and kind of apply to the current market situation?
Well, I want to bring it back around how we kind of started. We talked about folks sitting for their CFP certification over this past week, and trying to do it in such a turbulent week. But when all the dust settles with all of this, there is going to be as great a need, if not more, for knowledgeable financial advisors. And there's going to be a demand for the help. A lot of folks will be pushing reset. and really needing to look at the whole financial plan again. Are we still okay? What needs to be adjusted? And so I would stay the course and hang in there, and not try not to panic professionally from am I going to lose all my clients? But I also would think we would need to be pretty proactive in being in touch with them, just to reach out and let them know that you're there and that you're going to help them through this, even though it's as bad as anything we've ever seen. Just don't give up on your clients and be proactive about it.
Yeah, that's a good call, Mike. These are definitely the events when people realize if they have a good, trusted advisor or if they have an advisor who's been phoning it in for the last 5 years. Because really in the past, since 2009, you could have been on vacation and still be making money hand over fist.
Yeah.
Now's where the good financial advisors really earn their salt.
Yeah, and these
really
are
is-
opportunities where, it creates sometimes the door opens a little bit, and someone else might get a shot at that client, and that's why we have to be proactive about being in touch.
And the goal is, the period of time like this where it's really been a shocking move. If we take a look at historically, we've never seen a market go from an all-time high to a correction with the speed at which this one has. Again, we were at all-time highs on the benchmarks on February 19th. Here it is March 16th. And it's a totally different story. And it's all based on a virus that is, came out of nowhere, and it moved voraciously across the globe. And so when you look at it, people are nervous. There's a lot of fear in the system because people are worried about their health. They're worried about the health of their loved ones. They're worried about their ability to provide food and essential things to their family. So we're seeing hoarding in stores. And on top of that, they're worried about their money. They've seen just like catastrophic losses potentially in their portfolios. And, the decision that has to be made is to whether or not you need to make changes or react to what you're seeing, and, how long-lived this type of event could be. And again, with it, I'll point to what we've talked about a couple of times. It's just so much uncertainty. You just don't know, right? Are we going to have an experience like they've seen in Italy? Are we going to have an experience like they've seen in Indonesia or the Philippines, where it's a little less significant, at least at this point? And so you hope that the fact that the government has gotten out as far ahead of this as they can, and they've done just really shocking things that are really difficult decisions to make, by canceling the NCAA tournament, canceling all the professional sports, closing down bars and restaurants. And I'll tell you what, closing down bars hurts because you really need it at this point, right? And so, but
Ireland closed all bars. I was shocked.
It's a sign of the apocalypse, right? So
Yeah.
and when you're making those decisions that you're really going to impact people that aren't like the Jeff Bezos of the world, that just maybe don't have that cushion built up. And again, coming back to a financial planning standpoint, this is the reason why you have the emergency fund. These unexpected things that come out of nowhere and perhaps upend what you thought was going to be the next couple of months. But now you're prepared, right? You've got the ability to kind of ride it out. And certainly, hopefully, the government comes in and helps those people as well. But to not have to rely on that happening, to be able to do it on your own. So that's why these things that you learn about in your financial planning studies are relevant and important, because you can't predict these things. No one would have thought a month ago today, on February 16th, no one. People would have locked you up if you said, well, there's going to be this virus and it's going to shut the world down. They're not going to play the March Madness. Like, you would have been locked up. But now here we are, and so it's where do we go from here?
That's true. Though we did kind of see a crash coming, just no one really knew what was going to be the catalyst.
I think people definitely felt like, we may have been whistling past the graveyard as a result of all of the monetary policy accommodation that had been put in the system, and the fact that things had moved up so quickly and Tesla hit 900, that wasn't a sign of the end.
Yeah.
Where Tesla had the market capitalization of Ford and GM combined doubled. And so it just, so certainly there was definitely some excess in the system. But we had a really strong underlying economy to kind of justify it. You could point to it and say, okay, well, we're a little expensive relative to history, but I can justify it because of X, Y, and Z. And then again, when this black swan kind of swims into the pond, and you don't see it coming. When you first see it, you don't recognize it as that event. And now, again, the speed of this is just historic. Hopefully it's a recovery that will be of similar speed. But, your goal as the planner is to use those emergency funds if needed, and, try and keep people on target in terms of the plan, and only make decisions based on economics, not emotions.
Right. And the silver lining of this all is great buying opportunity.
Yeah, well, I would hope so.
Yeah, lots of discounts out there. We were talking before the show. I was gonna buy a new car next week, but now I'm thinking about just taking that money and putting it in the market a little while instead.
Yeah, I mean, I think that there are things that can be done. And I'm not a huge fan of government intervention and things, but the government's there for a reason, and certainly times like this are one of those reasons. And so some sort of, obviously the Federal Reserve and other global central banks have done what they can from a monetary policy standpoint to shore up the financial system and to make sure there's liquidity. Now it's incumbent on governments to, especially, let's just leave it at the U.S., to infuse some sort of fiscal stimulus so that people know that they're going to be okay, and so that business owners can make decisions and plan out so they don't have to lay off a bunch of people, which, it feeds into itself. That's those types of things make these events last longer. And so hopefully we can get to a point where politics and partisanship is kind of put down for a little while in the interest of the country, and we get to something that is intelligent and logical and makes sense to the market, and is quickly implemented for the benefit of everybody that's going to be negatively impacted by this.
Right.
And that is no small feat given the division that is going on right now.
Yeah, it reminds you of the late 60s when we were talking about just that political divide where, again, you just have it feels like we're as wide apart as we ever have been.
Yeah. Well, I hope they do what's right for America and don't just fight for partisan sake,
It's interesting. From what I've been seeing, though, this has been one of the most unifying events that we've seen in years. Like, they're getting legislation on the floor that I didn't think was possible. And like Mitt Romney today came out and decided to put forward a $1,000 basic income for Americans. Like, that is something I never would have thought I would see from Mitt Romney.
No, it's, I mean, I think that the goal would be to get something that we get enough people to agree on, that we can move it to the president's desk, get it signed, get it implemented. Get people the security or the sense of security that they need to not have to worry about where the next paycheck is coming from because of, again, a virus which by all accounts and measures should be relatively short-lived. This is not like the financial crisis where all of a sudden we realized the whole thing was rigged and there was a big problems. This is just a virus, right? And so you want people to focus on their health and the health of the people that they love, and not necessarily worry about this as an economic issue.
Well, some good lessons from history that we can draw from. Going to be interesting to see where we go in the next couple months. I'm hoping we're near the bottom, and we just got nowhere to go but up from here.
Yeah, I'm hoping that the next podcast is about taxes.
Yeah.
As opposed to, Crisis Part 2.
Yeah. If we do Crisis Part 2 for our next episode, then you guys can start to worry.
Yeah, get those bars open. Yeah.
Well, thank you guys for your insight and your comments. I like listening to you guys when you get into this stuff.
Definitely.
Well, certainly, take care of yourselves and be smart and be safe, and hopefully we get through this pretty quickly.
Yeah, definitely. And it does get better. Just remember that, everyone.
Yep, we always get through them all. All the ones that we just listed, we survived.
Exactly.
That's right.
Well, that does it for this week. Thanks for tuning in, everyone. And make sure to check out our backlog of episodes at bifbites.com.